joins us right now on the show. Adrian, really appreciate you joining us on a short notice. Neeraj here, good morning. How are you looking at the current landscape? Because there is geopolitics, there is this US data which is not looking very good for the economy, and the yen carry trade happening simultaneously. Which is the bigger trigger? What is it that you are watching out for, and what's the likely impact?
So I think the context here is that you've had very good returns from the US capital markets. You've had a successful yen carry trade, and we're moving into the summer months. And there have been some reasons why people have begun to unwind those positions. You know, a stock like Nvidia is still up substantially this year, even with the type of correction we've seen. Now, we have had some important data in terms of a change in perception about the US economy. So that loss of momentum in the US labor market, you know, still printing an increase of around 117,000 jobs, but some concern that most of those were in the public sector and healthcare, has caused people to sort of question about the robustness of US growth. And you've seen that being reflected very nicely through what the bond market has done and the equity market selling off as bonds rally. I think the danger here is that you read a little bit too much into what the markets are doing and try and extrapolate that into a real fundamental change. I'm not sure that is the case. You know, with the yen carry trade, which you referred to, which was another sort of risk on trade, the Japanese central bank, the Bank of Japan, came in with some relatively large intervention and has caused people to close out positions in that trade. But as I look at that trade, I still think the Japanese economy is fundamentally very weak. Demand there is weak. The inflation they have is imported inflation, not really caused by domestic issues. My suspicion actually is the sort of the yen weakness fundamentally will reassert itself. So it's really going to go back to what's going on in the US. So we've had this notably weak data point in the labor market relative to what we've been expecting, or what we've experienced in the last several years. The other thing that I would note in terms of weak economic data is the global manufacturing PMI, which is in contractionary phase. So what do I expect over the next couple of months? I actually think this volatility will continue. It is possible, markets will be lower, as we exit the summer, but I don't see this as a significant ongoing correction that people should get overly anxious about.
Okay, you don't. So then, Adrian, tell us, I mean, what could be the harbinger of good news from Bull's perspective? Would it be Fed rate action? Because suddenly I see maybe your ex-house too, but some of the other global banks all talking about how their assessment or assumptions around the Fed action has changed. Citi, Goldman, JPM, everybody now believes anywhere between 50 to 100 basis points in the current calendar itself.
Yeah, I mean, that's the good news here is that the Fed's got rates at 5.25. So there's plenty of room for the Fed to cut rates if economic data is weakening. And Mike Feroli reacted to the labor market data, the PMI data, and he's now calling for a 50 basis cut at the September meeting and perhaps another 50 basis point move. Now, when you sort of think about 50, that seems like a lot. We've been, tightening in 25 basis point incremental moves. But to move back down to a neutral level, which perhaps is what the economic data is now signaling, then you would like to see a decisive Fed. And I think a 50-point cut seems very rational considering the new data points that we have. But that usually is pretty good news for equities. And I think it might, as you look at this weakening economic data and then you reflect on what's really been happening in the US equity market, if you look at the equity indices that's equally weighted, it's barely done anything. We've had a very narrow market. I think there is an argument that the market does actually broaden, and the more cyclical stocks, which have been performing poorly because people have been worried about the Fed's tight policy leading to slower economic growth, they can now look ahead as the Fed begins to ease. And okay, the economic data is likely to deteriorate, but remember, equities look 12 months ahead. So if the Fed is easing, it might actually cause a broadening of the market into more cyclical stocks.
Also arrest the ongoing correction, Adrian? Could the Fed play the role or could it be something else? And very quickly, Adrian, just 2 minutes left to market open. A quick view alongside that on Indian markets.
A lot to do in such a short period of time.
Sorry.
I think the Fed can obviously help markets by decisive action. Now we're talking about September, so we have to wait a bit for that. Look, I think India, remains somewhat as an isolated story. It's clearly done incredibly well within emerging markets. The Indian fundamentals continue to be strong. It's suffered in terms of international flows because people have not liked emerging markets, and they haven't liked emerging markets because of issues around China, but they haven't liked it because the dollar's been strong, Fed rates have been high. If the Fed starts cutting rates, that tends to be good for EM, which means broad flows into passive EM products and active EM products. And India will probably benefit from a pickup in FII inflows if the Fed moves into a significant easing cycle, which, if it does move by 50 in September, would be a pretty strong signal, wouldn't you think?
Yes, indeed, Adrian. Would be a pretty strong signal. But thank you for laying it out. I know the time was short, but I appreciate you playing ball. And thank you so much for joining in today and giving us your thoughts this morning. Very important to have them.